The most dangerous break in finance is not when prices fall, it is when belief breaks. Prices can recover from panic, markets can recover from recessions. Even bad policy can sometimes be repaired if the institution behind it still retains credibility. But when the market stops believing that the central bank is steering because it wants to and starts believing it is steering because the debt structure leaves it no real choice, that is a much more profound fracture. That is what I believe you are looking at now. Not just another Fed decision, not just another debate over whether the next move is a cut or a pause or some technical adjustment hidden behind polished language. What broke is bigger than that. So let me give you the one mother line that everything in this story serves. The real danger is not that the Fed changed policy. It is that the market is beginning to understand the Fed no longer fully controls the system it is pretending to manage. That is the line. Not the press release, not the dot plot, not the ceremony of central banker language control itself. Because for most of the last 40 years, investors lived inside one great comforting assumption. Whatever happened, the Federal Reserve would eventually restore order. It might tighten, it might cut, it might break something, then mend what it broke. But behind every crisis, behind every valuation regime, behind every cycle, sat the same quiet faith. The Fed still had tools, the Fed still had room, the Fed could still choose. That faith has been one of the strongest hidden pillars underneath asset prices for an entire generation. And what I think is happening now is that pillar is beginning to crack, not publicly, not all at once, but in the only place that really matters first. The bond market, that is where reality begins. A lot of people still watch stocks as though stocks are the whole economy. That is a childish way of understanding markets. Stocks are attention, bonds are structure. Stocks tell you what people hope, bonds tell you what people require. Stocks can party on delusion for quite a while. Bonds eventually demand arithmetic, and arithmetic is where this whole story turns ugly. Now, let me walk you through the mechanisms. The first mechanism is Volcker's shadow. Every central banker in America still lives in the shadow of Paul Volcker, whether they admit it or not. Volcker did one thing that defines real monetary authority. He proved that when inflation threatened the credibility of the currency, he was willing to impose enormous short-term pain to preserve long-term trust. That is what markets remember. Not because they enjoy recessions, not because they romanticize hardship, but because credibility is built when an institution proves it will choose discipline over immediate comfort. That memory still haunts markets because it established the gold standard for central bank seriousness. If inflation becomes dangerous, the institution must be willing to hurt the economy, hurt politics, hurt popularity, and hurt short-term market sentiment to preserve the value of the money itself. That is the standard. The problem is that today, S system is not built to survive that standard cleanly. That is why Volcker's shadow matters. It reminds us what real monetary leadership requires while simultaneously exposing how much less freedom the current Fed appears to have. A credible institution does not merely speak tough. It can afford to act tough. The deeper question now is whether the Fed still can. That leads to the second mechanism. I call it the deferral regime. After 2008, the system made a choice. It chose rescue over purge. It chose zero rates over cleansing. It chose quantitative easing over deep liquidation. It chose to preserve the architecture by socializing risk into the balance sheet of the state and the central bank rather than allowing the full consequences of prior leverage and malinvestment to burn through the system. That worked. In one sense, it bought time, it lifted asset prices, it restored confidence, it reinflated balance sheets, it trained an entire generation of investors to believe the central bank had discovered a superior way to manage capitalism. But I never thought the problem had been solved, it had been deferred. That is the deferral regime. When you suppress pain long enough, the pain does not vanish. It changes shape. It migrates from one part of the system to another. Private excess becomes public burden. Short-term healing becomes long-term fragility. Every rescue creates a new constituency addicted to rescue. Every round of cheap money changes what the system can tolerate. The next time conditions turn hard, that is what I believe we are paying for now. Not one bad meeting, not one political decision. A 15-year habit of teaching markets, corporations, governments, and households that the answer to every meaningful stress event was cheaper money, more liquidity, and another deferral of the reckoning. That is why this is not a normal cycle. It is the bill for a very long era. Now we come to the third mechanism. I call it debt dictates. This is where the whole story stops being abstract. The United States government is no longer merely highly indebted. It is deeply rate sensitive. The debt load is so large that what used to be called an ordinary interest rate environment now creates an extraordinary fiscal consequence. When rates rise or stay elevated, the interest cost on the debt does not remain a line item in the background. It becomes a major national expenditure that changes policy, or rather, it begins changing policy before officials admit it. Because a government running giant deficits while also facing compounding interest expense does not enjoy the same menu of options it once did. Tight policy for a short spell is one thing, sustained restrictive policy in a debt-saturated state is something else. It starts to crowd the budget, it starts to dominate issuance, it starts to push the sovereign itself toward a place where lower rates are not merely desirable for growth, but increasingly necessary for fiscal survival. That is the point where debt begins dictating terms, not through speeches, through arithmetic. This is why I say the Fed is under a pressure the public still understates. The pressure is not just political, it is structural. The system above it, the Treasury, the issuance schedule, the refinancing wall, the compound growth of debt service is getting louder. And if the central bank's stance begins shifting in ways that appear politically convenient but economically premature, the bond market notices immediately. That is what I think you are seeing. Not a market misunderstanding the Fed, a market understanding the debt. Now let us move to the fourth mechanism. I call it the long end revolt. This is the clearest signal in the whole system. Normally, if the central bank turns softer, the long end should feel supported. Investors should say, good, easier policy is coming. Duration is safer, risk of continued restrictive stance is lower. Let us buy longer dated treasuries. But if the long end refuses to behave, if yields remain elevated or even climb while the Fed is signaling accommodation, then something very important is being revealed. The market is not convinced. Convinced of what? Convinced that easier policy under current fiscal conditions is benign. Convinced that inflation risk is contained. Convinced that the sovereign deserves the same privileged structure it once did. Convinced that the old relationship between Fed easing and long bond comfort still holds. That is the long end revolt. The long end is where global capital asks, how much must I be paid to hold this promise for years? If the answer keeps rising despite softer Fed language or action, then the revolt is already underway. Not a theatrical revolt, a pricing revolt. That is much more important because the 10-year and 30-year markets are not voting on Jerome Powell's personality or the wording of the communique. They are pricing confidence in the future purchasing power, future issuance burden, future fiscal discipline, and future inflation credibility of the issuer. If that price of confidence keeps rising, the old policy machine is malfunctioning. This is why I keep saying the bond market is the real story. When the long end stops cooperating, it is no longer enough for the Fed to sound supportive. Support has to be believed, and belief is exactly what is under pressure. Now we come to the fifth mechanism. I call it Tina's funeral. For years, equities floated on one deceptively simple idea. There is no alternative. If cash yielded nothing and bonds yielded little, then capital had no dignified place to go except into stocks and other risk assets. This was one of the great hidden supports of the entire post-2008 regime. People did not always buy equities because equities were cheap. They often bought because the alternatives were dead. That was Tina. And once Tina ruled the landscape, valuations became easier to justify, concentration easier to tolerate, and risk easier to ignore. But Tina dies the moment there is an alternative. And now there is one short-term sovereign paper yields something meaningful. Cash has optionality. The hurdle rate for paying absurd multiples on growth stories is much higher. Risk assets can no longer rely on the old subsidy of zero. That changes everything. It does not mean stocks must crash tomorrow. It does mean the old valuation logic is much less defensible than the market still pretends. This is why I look at large cap growth and do not merely see good companies. I see a market still pricing parts of the old regime as if the old regime can be restored on command. I do not think it can. Not cleanly, not with these debt levels, not with this bond. Market message, not with this geopolitical map. That is why I say the risk reward has worsened so dramatically. The market is still clinging to yesterday as multiple logic in a world where yesterday as monetary foundation is visibly weakening. That is not a small mismatch. That is the setup for disappointment. Now let me take you to the sixth mechanism. I call it reserve credibility. The dollar still dominates because the United States still possesses enormous strengths. Deep markets, rule of law, military reach, institutional history. None of that disappears because the macro picture is getting more difficult. I am not interested in cartoon collapse narratives. They are unserious, but I am very interested in erosion reserve. Currency privilege is not a divine right. It is a confidence contract, and confidence contracts erode when the issuer becomes fiscally reckless, when the central bank appears politically pressured. And when the rest of the world begins adjusting behavior at the margin, that adjustment rarely begins with a scream. It begins with quiet reserve diversification, alternative settlement structures, more trade outside the dollar, more gold accumulation. More hesitation about keeping all national savings inside one paper system run by one increasingly indebted state. That is reserve credibility. And once enough actors begin questioning it simultaneously, the structure becomes more fragile than it appears on television. Again, not because America vanishes, because the market no longer gives its paper the same unquestioned premium forever. That is where gold enters for me. Not as a panic asset, not as a meme for doomsday fanatics, as a very old answer to a very modern problem. What do you own when the state running the paper system is still powerful, but visibly less disciplined, more indebted, more politically constrained, and more tempted to choose the easy short-term path? You own something outside the promise. That is the logic. Now I want to force the identity shift because without it you will keep reading the Fed like a spectator reads sports. Stop thinking like a Fed interpreter. Start thinking like a credibility auditor. A Fed interpreter listens for tone language clues, phrasing. A credibility auditor watches whether the bond market cooperates, whether fiscal arithmetic is survivable, whether Tina still holds, whether long-term capital still grants the same trust, and whether the institution can still impose pain if pain becomes necessary. That is the stronger identity, because what matters now is not what the Fed wishes the market to believe. What matters is whether the market still believes the Fed is free enough to act like Volcker would have acted if the situation demanded it. That is the real question, and I do not think the answer is reassuring. Now, let me give you the operating system. First, stop treating Fed easing as automatically bullish. If easing is being forced by debt arithmetic or political pressure while the long end resists, that is not clean support. That is a warning. Second, respect the bond market more than the stock market. The stock market can party on hope. The bond market eventually demands payment. Third, understand that the post-2008 rescue regime solved less than it concealed. Today, stress is not random. It is accumulated consequence. Fourth, look honestly at index concentration and valuation exposure. Great companies can still be terrible buys if they are priced for an old monetary world that no longer exists. Fifth, own optionality. Cash is not only a return question, it is a future decision question. Sixth, own some real assets that do not depend on institutional credibility. Staying intact forever. Gold fits here for me. Seventh, stop waiting for certainty. By the time the market fully admits the regime changed, the repricing will already be behind you. That is the heart of it. I am not telling you the market must collapse tomorrow. I am telling you the probabilities have shifted in a way that I find profoundly uncomfortable. I am telling you the old assumption that the Fed can always save the cycle cleanly is weaker than at any point I have seen in a very long time. And I am telling you that the investors who ignore that because the index is still near highs or because the last decade trained them to believe every scare is just another dip are taking more risk than they understand. That is how great fortunes get damaged. Not in ignorance of headlines, in complacency toward structure. Now, let me end where this really matters. You can keep believing the old story. You can keep assuming that the Fed still owns the board. You can keep trusting that the bond market will eventually fall in line, that Tina will somehow return. That fiscal recklessness can be papered over indefinitely without consequence. That policy easing will once again feel like rescue instead of surrender. Or you can do the harder thing. You can admit that a central bank easing into a structurally unconvinced bond market is not reassuring. You can admit that debt is no longer just a background macro statistic, but a direct force shaping policy itself. You can admit that the old regime may not die in one dramatic moment, but it may already be losing credibility in the places that matter most. That is the threshold, because once belief breaks, prices eventually follow. And when that happens, people will say the warning signs were obvious in retrospect. They always do. The investors who survive and even profit are the ones who respected the signs before consensus gave them permission. That is the mirror. Look into it carefully. The Fed did not just break something technical. It may have broken the old faith that it can still control the system above politics, above debt, and above arithmetic. And once that faith breaks, you are no longer investing in the old world. You are investing in the repricing of a new one.